All right, I just looked at the 10-year Treasury yield and I saw how it's been falling due to the PMI, that's the services PMI that was released today. And we can compare also the yields that were 1.368 at the US as of 9/10 in this release by FactSet that was brought to us through Tulip Prebon at the TD Ameritrade Thinkorswim terminal, and we can compare it to like Germany, which is the lowest at negative 2.53%, and the US at the highest. So no kidding, because the rest of the world is still in a massive growth issue because of COVID lockdowns. And although Germany has the least problems of in terms of COVID in Europe, relatively speaking, you can still see that they have very low, and all of these European countries have very, very low yields. Only the US is above 1, and this is going to keep going down because our inflation month on month from the services PMI is showing that that really inflation is not here. It's transitory. And yes, that is services, but also the non-services, the manufacturing PMI has been dropping. So all of it's dropping. The narrative that inflation is here permanently is not true as of now. Things may change. We'll see how supply chain shocks are going to continue or not, but this looks good. I've got a massive pullback on my tech stocks, so I'm going to buy more. And returning to this, we can see that because the U.S. yield is the highest of all of these developed countries, including Japan, but really compared to the rest of the world, because Europe is not as bad as Africa or some parts of Asia in terms of the COVID, or India and stuff like that. So I'm sure if we pull up a chart of yields for every country, the U.S. is probably at the top or one of the top, and we can see that really just by common sense. But because the yields are highest here, a lot of these other countries, their investors are going to be buying our bonds because the prices are basically low, and yields are relatively high for them, given their country's bonds are not yielding that much. And I think the same is going to happen with the stock market too, that they're going to be buying into the growth, into the value of the stock market, into the whole S&P 500. That's probably explaining what's driving this, is that they have a need for yield and return, and equity is returning that, but also the yield on the treasury bonds are going to be returning that too. So, hey, I'm just going to show the ISM Services Index that was released as well as today on the 10. This I actually believe it was 10:00 a.m. Eastern Sun. So this is just publications on TD Ameritrade a little bit later than that. But ISM non-manufacturing index decreased from 60.1% from 64.0% in May. Again, that May was the worst figure in terms of top line figure year on year, but that's due to base effects. And then when you look at the consensus for this month, 63%, but it was 2.9% lower. That indicates a second derivative that is negative 2.9%. If that continues as it has been since the May figures, we're going to see this continually get lower and lower, this top line figure. Obviously, 50% is the baseline, 50% is the dividing line between expansion and contraction. I don't know if we'll get to 50%. I don't really know. I doubt it, unless unless we have this Delta variant get really bad. But I don't expect this figure to remain as high. There's more information here. Price index dipped to 79.5% from 80.6%. Employment index, so this is the prices, and the employment index dipped 49.9% from 55.3%. So these are how it breaks out, really, all these. But the top line figures, as you can see, is it's decreasing. Here's looks like the past figure. So we saw that May top line figure was the highest for the ISM index overall. and as you can see, it's bouncing. Sorry, excuse me, it's going the reverse than I expected. February is not yet the highest because the baseline effect wasn't there, but when we get to May, that is the highest because of the baseline effect. May on May was May on May of this year on last year's May had the largest increase due to the drop in May of last year being the sharpest compared to the other months. Although we were dropping from February onwards, and so we could see this increase in the services manufacturing index continue, and as expected, top line drops because when you pull up the report in this month, as with CPI and the PMI and other reports, you start to realize that the second derivative, the change on the change in the index, is actually negative, which causes a fall in that index. And this here is again a drop on here, and we're going to see that this continue. So this is good news for growth, bad news for wages and employment. I think that the expectation that that was going to occur so fast, it was always unreasonable, and it's really unfortunate that that got into the minds of people that maybe there would be a persistent higher wages or something like that. But I don't think that's been in the real world. I don't see people really asking for higher wages. I see people really more like coming back in and say, "Oh, I'm going to start looking for a job," but not the other way, as some people in Wall Street, most of Wall Street thought it might be.